This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's go ahead and get into the chart deck, though. Listeners, you'll find the download link for this week's post-game chart deck in your Research Roundup email. Now, if you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads above Adam Rosenswag's picture. Patrick, the chart deck is titled Post-FOMC Market Moves. That means you have a crystal ball and are about to tell us exactly what's happening next.
Well, at least what just happened. How about that for accuracy? But anyway, the key thing here to look at is we were talking about this descending trend line pivoting around the 4,000 level, including the 50-day moving average and the fib zones all kind of lining up. And we were saying in order for the bulls to be able to put anything together, we would want to see them be able to demonstrate that they can actually put together a couple of bullish days that actually does some real technical repair work and start to turn the charts up. And really, we've over the last week have seen the bulls really start to get a little bit of momentum behind them. Now that we're trading above the 50-day moving average, what we have is a 200-day moving average that lies right around the 4,200, where all of the January, February, March lows have occurred. And often what were previous lows act as overhead resistance. So it'll be really interesting to observe whether the bulls now can put together, 100, 150 points over the next week or two and drive toward the upper resistance levels. I still am not sure that I want to flip fully bullish. While we went through a 6-month bear market, often there are these bear market rallies that often is just a pause of the previous selling, just simply because it's not going to just go crashing down, at least not every time. And what we can see here as we approach this is whether or not, as we get into September, October, whether or not the market starts to roll over again, or whether we really see that a meaningful market bottom is solidified. And that's the puzzle piece to solve throughout the month of August. Right now, on the short term, a little bit of follow-through strength towards 4,200 seems a path of least resistance.
Patrick, one of the things I've been reading online is a number of people are saying, look, a lot of hedge funds are really getting battered here because they were short. Could this just be the mother of all short squeezes, that we're going to see a large-scale short squeeze that kind of washes out all the shorts over the course of the summer and then things get negative again in the fall sometime?
Oh, you know what? I think if it was a genuine short squeeze, it'd have more momentum. Usually, those that are being stopped out as shorts can drive a much steeper and sharper liquidity squeeze than just a crawl higher like we've been seeing. It'll be far more interesting to see if these charts are turning up, whether it actually creates a little bit of FOMO in the hedge funds, which is that they're underweight the equity and seeing the market moving, whether it actually puts money to work on the short term that drives that move a little bit higher. I still don't see the underpinning conditions in my mind that would make a legitimate new bull market start. But I think that the market pausing here is obviously the reality of the current situation. Another thing that's a tailwind to that, if we go on page 3, is just looking at the volatility index. And as volatility of the markets narrows, it actually fuels some dealer buying as they can unwind a lot of their hedges. And so the fact that the VIX legitimately broke below 25 at this level is actually a short-term tailwind. One of the things that we'll be seeing is, if we see volatility normalizing back down to 20 or into the high teens where we saw over the last year some of the lows establish themselves, that could be a short-term tailwind to the sales of the market and could continue to contribute to that market crawling higher. While I still think that the bear market legitimately may not be over and another full leg lower may be coming later in the year, we have midterm elections coming and everything is quiet here. It would be really interesting to see whether that summer doldrum theme that we were talking about just has a market grinding in a range and simply lacking any real meaningful conviction. And that really does seem to be what the current market price action is suggesting.
As we move on to page 4, I find it very interesting to compare the Euro-USD chart to the dollar index chart. Because if I look at the dollar index chart, to my eye at least, it looks like a healthy consolidation. It looks like the 106 support is holding pretty nicely. I'm not too worried about it dumping lower. But boy, if I look at Euro-US dollar, this chart doesn't look pretty to me.
Well, of course, it's the inverse, right? And I think the noteworthy thing is that one of the things that I think would be actually a genuine tailwind to risk assets would be if the euro was rallying and the U.S. dollar was going through a more meaningful or deeper correction. And really, there is no sign of that. I mean, the euro was so oversold when it hit parity, and it had every reason to meaningfully bounce even as high as 103, 104 on the upside. And after just a 2-3 day little slingshot reaction to 102, the euro is just stuck, and it just feels heavy. And I wonder whether some catalyst can really emerge to change this trend. And I think that this actually is not working in the favor of risk assets. If we see that the euro rolls over and starts to sell, that would be a stress point. The one thing I don't have a chart of here where the pushback on that is what the price action we're seeing in that US dollar yen, because the US dollar really has more meaningfully begun mean reverting that huge bull run that it had against the yen over the last half year. And so we're really starting to see that we're going from a period where almost all cross currencies were perfectly correlated and the US dollar up was the dominant one. We're now starting to see a lot of mixed messages from the different currency crosses, which is actually making it a bit of a messy kind of call to make here. It'll be really interesting, though, to see whether the euro continues to behave like this, and even if it does have a quick little pop to 103, whether it quickly rejects and comes right back down. Right now, there is no sign of a pulse for the euro bulls.
Now, you said earlier that we weren't really seeing brisk price action on the S&P. Well, if you want to see brisk price action, take a look at that gold chart on page 5.
Oh, yeah. That's what a move. Now, I always want to say one thing. I always say to my members, which is one day doesn't make a new trend. I'm reluctant to already dynamically change my views just because of one up day. We're going to really want to see whether or not this draws new money flow and whether there's follow through and other things like that occurring. But we had an incredibly oversold gold market, and like we called on the show, it was testing an incredibly important support. It was a multi-year low along that 1680 to 1700 zone, and you had a bullish engulfing candle come in there right off of that low, and now with this reversal, it's at least putting in now a short-term bottom, but it'll be much more interesting, like Adam was suggesting earlier, which is it going to lead to more of an intermediate to longer term bottom? Often that will involve the market retesting its previous lows or doing some sort of a basing formation. And so it'll be really interesting to see whether gold bases here throughout the summer and then subsequently sets up for maybe a fourth quarter change in trend in a bull run. I think it's going to, like I said, one day doesn't make a new trend, but certainly the short-term selling pressure has really subsided, and it really seems like gold is now going to give it a shot on the upside. We'll see whether it can beat those moving averages.
Well, Patrick, I'm going to give you first dibs on talking to the crude oil chart, because once you let me talk,
No problem. Well, isn't it interesting, though, Eric, that crude oil market is pinned right between the 200-day and the 50-day moving averages. 200-day being down at the $90 level, and the 50-day being up at the $100 level. And I think you don't have to make it more confusing than simply waiting for crude oil market to commit on a breakout. I don't really envision any sustained sell-off below 90. I think even if we had a short-term liquidity washout that, pokes down to $85, it would probably be almost immediately bought up and taken right back up, almost like the nat gas market did. But I think watching to see when the breakout happens out of this range will really define when a potential new trend move may be committing. And I think at this moment, considering a trade range bound and watching those support resistance levels is a easy way to technically observe when the next trend commits. What's your take on all of it?
Patrick, with respect to the chart and where the price action is headed from here, I basically agree with you. I use several moving averages on my charts, both the contract and continuation chart levels. Right now, the 200-day moving average on the continuation chart is at 94.27, and that's the level that's pretty much been holding. It's been tested quite a few times. As you mentioned, the 200-day contract moving average is actually down just below 90. It's actually 88.27. I was previously thinking that we were going to get down and test that, but we've had several tests of the continuation 200. One was a deep plunge below it. The next one was just a little plunge below it, and then last night we had one that kind of got close to it but didn't even come down to it. So we've got a new upsloping trend line, which looks like it's set to hold us above the 200, even the continuation 200 at 94.27 right now. And moving above that, I actually see the 100-day moving average on the contract chart, which is at 100.92 as the bull signal. If we get above that, it would take us also above last week's high, so we would have a pattern of higher highs and higher lows. It would also take us above a key moving average, and we're already trading above a longer-term downsloping trend line that's been in place since the sell-off began in June. It's not drawn on this chart, but you can kind of visually see it there. If you draw a line from the peaks in early June along where the price action is, you can see that we've just moved to the right of that line in the last couple of days here.
Eric, let's jump to, in the market wrap, you were talking about the SPR time spreads. What's up with that?
Okay, well, what was announced by the White House this week is they're going to be smarter, supposedly, about how they do these SPR releases. And the sales pitch is that by buying long-dated futures or forwards, the government can help the market now by pushing the front of the curve lower, and they can also help by providing producers with an easy way to lock in prices to replenish the SPR later. So essentially what's being proposed by the White House, if you translate it to trading terminology, is that the government would sell, let's say, a 6-month prompt time spread. So you're selling the front month contract, you're buying 6 months down the curve or a year down the curve, whatever it is that they want to do. That would result in a profit for the government. It's 6-month time spread until very recently was much higher. Even now it's upwards of $10 a barrel that they would make as a profit as a result of doing that. And if they were really serious about this, what they would say is, okay, so from now on, we're not going to just release any oil out of the SPR willy-nilly. When we do that, the way we're going to do it is sell the front month futures contract or sell a forward, the equivalent of the same thing, so that we're going to deliver oil out of the SPR against that front contract. But at the very same time, we're going to enter a contract, whether it's buying a futures contract or entering a forward contract, to buy later dated crude at a lower price. So we're guaranteed that the taxpayer is going to pay a lower price to replenish the oil that needs to go back into the SPR when the time comes to do that. I'm guessing that some smart person in the government came up with that idea and proposed it to the White House. And they said, yeah, that sounds good. We can spin that as if we were actually doing it. But the part about actually buying those longer dated futures or longer dated forwards now, we'll put that off. We'll do it later. Trust us. So in the next fiscal year, then we're going to buy those long-dated contracts and we're going to do all this stuff. You can trust us. I don't believe any part of this. It doesn't pass the smell test. They're not really doing a time spread trade. They're describing how a time spread trade would work, even though they're not really doing it. And it would be, frankly, any SPR release at a time of geopolitical tension like this is reckless and irresponsible. It's not what the SPR is for. But if you were going to do an SPR release, doing it the way they are kind of alluding to would make a lot of sense if they were actually doing that. It's the fine print about after the 2023 fiscal year begins is when they would actually do the other side of it. So they're going to do one side of that time spread trade and hope to leg into it after the 2023 fiscal year begins. I think that's November 1st, if we're talking about a federal government fiscal year. They're going to hopefully leg in and get a lower price, and they're not going to get whipsawed as the market maybe moves higher from there and they end up paying a higher price to replenish. I don't believe any part of this story, Patrick.
Eric, there was also some big news on the Nord Stream pipeline. What's the news there?
Of course, Nord Stream 1 is the pipeline that supplies Europe with natural gas from Russia. It was shut down for maintenance. They turned it back on last week, and now this week they've throttled it back intentionally to just 20% of its rated capacity. The explanation that was given is that there was another unspecified issue with a second turbine that is needed to pressurize the pipeline, and that's the reason. It's just technical difficulties. Don't worry, we're working on it. It sounds to me, frankly, like Putin is intentionally trying to show his teeth. He doesn't want to completely shut the gas off to Europe because that potentially starts a big geopolitical escalation. He only wants a little one right now. So he's showing them that he can turn the screws up or down at will, and for now it's throttled back to 20%. I'm guessing that Putin wants to put some pressure on Europe and make them feel some pain for a few weeks. And then I would guess that this supposed turbine problem will miraculously cure itself and he'll turn the gas back up, but probably not enough to allow them to replenish their underground reserves, only enough to keep them going so that we don't get a major escalation for now. I think he's getting ready to really put the pressure on come fall heating season. Now, what's a mystery to me, Patrick, is everybody is talking about the fact that Vladimir Putin is obviously withholding natural gas from Europe as a tool of economic pressure, or even economic warfare, if you want to call it that. So why it is that nobody seems to think that Putin would consider taking Russian oil off the market as an act of economic warfare is a complete mystery to me. It seems obvious that if he's willing to turn the gas off, he'd probably be willing to turn the oil off. It's not time to do that yet. It doesn't make sense strategically, but at some point I think it will, and that's the reason I feel so passionately that we should not be draining our SPR at such a critical time. It will be drawn down to only 53% of its capacity from more than 80% at the beginning of 2022 because of the White House's policy decisions, which I think have been incredibly irresponsible. And, just imagine what Putin could do to squeeze the West if he wanted to, how much risk we're creating. And I'm not saying that he has an agenda to do any of this. I'm just saying our policy decisions are creating immense vulnerability. If Putin wanted to, he could just give Europe as much gas as they need to keep them going until fall, but not enough to replenish their reserves. Then he could suddenly cut the gas to Europe and withhold half of Russian exports of oil. That would cause prices to spike instantaneously. It's entirely possible that it wouldn't even cost him anything in terms of revenue, because if the price doubles and the amount of exports gets cut in half, it's revenue neutral for Russia. And you think, well, wait a minute, we've still got plenty of capacity in North America. Yeah, we do, but remember, all of this shale oil that's produced in the United States cannot be refined in U.S. refineries until you blend it down with heavier oil. You got to have medium to heavy blend stock in order for U.S. shale oil to even be refinable, to be able to use it. Well, but we've got so much of it coming from Canada through the Keystone Pipeline. Okay, so what's to stop Russia if they were really trying to escalate a war situation or an economic war situation from sabotaging the Keystone Pipeline? And I'm not suggesting that they're going to hit it with a missile attack or do anything like that that would escalate a massive geopolitical tension. All they would have to do is insert FSB spies into the green movement and convince a bunch of environmental activists that the way to deal with big oil, which is evil, is we've got to bomb the pipeline and get a bunch of Americans who think they're doing the right thing because they're passionately committed to a, unfortunately, misguided environmental agenda, so excited that they go and bomb the Keystone Pipeline. I mean, there's so many ways that we are vulnerable, and to be draining the Strategic Petroleum Reserve at a time like this, I think, is crazy.
Well, Eric, let's move on to just kind of taking a long-term view of the oil market, of what's happening here in the big picture.
Patrick, as I alluded to in the market wrap, I am convinced that we are in the very early stages of a global energy crisis that will be bigger than the 1970s oil shock. The world, and I'll make a very profound prediction now, I say the world will not return to the pre-pandemic normal economy because it can't. Why can't it? Because there simply isn't enough energy supply to meet pre-pandemic energy demand levels. Nor is there any credible plan to get back there. We did so much damage to the energy industry because of the pandemic and the negative prices and everything that happened. And policy is so focused in the opposite direction, making desperately needed capital expenditure investments almost uninvestable. So there is no possible way, I contend, to get back to normal for at least 5 years. And that 5-year clock, for how long it would take to get back to normal, doesn't even start until you see a policy reversal and we start making the right choices and we start encouraging rather than discouraging new investment in both energy exploration and production and also in new refining capacity, because we have as much of a refining capacity crisis as we have a crude oil supply crisis. Now, the recession that's coming will hide this reality from most people for a while longer. It's entirely possible that oil prices go down from here, although it looks to me like maybe they're bottoming, but I could be wrong. And oil prices might very well go down another 10 or 20 bucks. But my point is the only way that can happen is because of recession-induced demand destruction. We can't recover back to pre-recession or pre-pandemic normal economic condition because skyrocketing energy costs will cripple the economy and hold us in recession. So we could have an energy-led stagflation. Now, all of that was true before the February 24th Ukraine event, and fixing it would require a total change of policy and attitude and at least 5 years of aggressive investment in both E&P and downstream refining capacity. Now, if you add to that the Russia-Putin angle, which is new, it's not the cause of this problem, but it definitely exacerbates it. I think Putin is smart enough to have a very strong understanding of this. He knows that the West is very vulnerable to having energy withheld from it, and he has the power now to engage in economic warfare centered on withholding access to energy. And everything he's doing, from inviting Saudi Arabia to join the BRICS alliance, the new global reserve currency that was just announced at the BRICS summit, Sergei Glazyev's new architecture for a central bank digital currency, which I predicted 4 years ago in my book, all of this is strategically in support of Russia trying to put itself in a place to control as much of the world's energy resources as possible and be able to withhold them from the West. We got into this, Patrick, from failed energy policy, and there's nothing that can correct it but a total change of energy policy and at least 5 years for that new policy to take effect, and it's going to be a really ugly ride.
Eric, I have to agree with so many of the points you're making, but when we go back to that interview that we had with Adam, he was really highlighting the natural gas situation as well. And boy, did that kind of catch me off guard. I never really considered a lot of the points he was making. And what I thought was really interesting was to just pull up a chart on nat gas, because what an extraordinary 2 months it's been this summer. First of all, nat gas made it up almost to $10 BTU and suddenly went through an extraordinary sell-off that literally within a month had it lose close to 50% 10% of its value. And when you see those kind of corrections, it often leads to a sustained sell cycle of some sort, as that's a pretty hefty correction. But just as fast as that sell-off occurred, even in a faster period of time, natural gas prices recovered all the way back to their highs, almost doubling off of that low point in just like 3 weeks. Incredible volatility that we're seeing. It's unbelievable, that thing. And the real question in my mind after listening to Adam's interview is like, is there really the potential here now for even another leg higher in this? And one of the things, I didn't put on any moving averages on here, but one of the things I'm going to be watching is this little pullback over the last couple of days. Will the bulls buy the dip? Will we see that the price action continues to challenge those highs? And is it setting up for something that I think would surprise so many investors, would be a natural gas breakout above $10 on a sustained basis? What's your thinking on that?
Well, it's very important, Patrick, to understand. Look at the pattern going back to the beginning of 2022. It's up, it's accelerating up, it's up, it's up, it's up. What happened that caused that sudden blow off top and the very sharp correction to the downside? It was the fire at the export terminal that Adam discussed in today's feature interview. Now, the thesis behind Adam's very bullish view that he expressed back in May in the letter that is linked in your Research Roundup email, that thesis was based on the idea that there's going to be a convergence between U.S. and European natural gas prices because we're getting more and more export capacity and therefore arbitraging those two markets by exporting U.S. natural gas and sending it to Europe becomes far more practical and possible than it ever was before. That was driving the rally exactly at the point where one of the major export terminals took 20% of U.S. natural gas export capacity, liquefied natural gas export capacity, got taken off the market suddenly with that fire. You see prices crash because all of a sudden the basis for Adam's thesis stops being there. We get all the way down to the beginning of July. And what I find most interesting about this chart, Patrick, is the sell-off starting in the beginning of June also coincides with the sell-off in crude oil prices, which most people attribute to the market pricing in the coming recession. But hang on a second. The crude oil kept on selling off on a very steady, consistent downtrend right through last week, and maybe it's still going to continue. We're right on some key support levels just as we're speaking right now. It's just about the pit close on Thursday, and we're touching on the 13 and 5-day moving averages. Not clear whether we'll hold them into the close. But Patrick, the nat gas recovered beautifully from the beginning of July. What happened in the beginning of July? They didn't fix the Freeport export terminal, which took 20% of capacity off. What did happen in the beginning of July is we saw Europe being pressured around the Nord Stream pipeline. Now, wait a minute. We used to think of the U.S. and European gas markets as being totally disconnected because you can't arbitrage between the two of them because it's too hard to transport natural gas. But it is approximately coincident with the turbine situation and people getting afraid of what could happen, the doomsday scenario about Nord Stream 1. That was all a Europe story. But look at how the recovery in U.S., because this chart is Henry Hub U.S. natural gas futures. It recovered when the pressure was put on Europe, and it was a short-term tactical pressure put on Europe. So it seems pretty clear to me that transmission mechanism Adam is talking about is real. And I would think, I haven't asked Adam about this, I should have asked him in the feature interview, it's not really an expectation that U.S. nat gas prices are going to parity with European prices, but rather the cost of export and transport plus U.S. gas price ought to reach parity with Europe. So the question there is, how much of a discount is there because of the cost of that arbitrage to deliver the gas? It's much more significant than it is for crude oil. But still, there's plenty of room with nat gas prices in Europe already $30 plus and set to go higher if they get squeezed. It could double or triple from here. There's plenty of room, I think, for Adam to be proven right and U.S. gas prices to move much, much higher. The big question in my mind is when that happens, when U.S. nat gas prices, let's say they do move sustainably above $10, Well, what does that do in terms of changing behavior? All the people that are flaring off nat gas in the U.S., I suspect would suddenly be motivated to build a pipeline. Of course, maybe they would be stopped from building that pipeline by environmental activists. I don't know. It's going to be very interesting to see how this plays out.
Moving on to page 8, let's talk about some of the other forms of energy. What's interesting, first of all, is that coal prices have been generally holding up, and now we move to this chart here on uranium, and it's kind of like all intertwined. Energy is energy, just comes in different forms, and the question is that if we have increasing shortages developing in the traditional energy markets, does that translate to regaining new bull markets in all of the periphery ones, such as uranium? And what's interesting is that we had a pretty solid breakout on the Sprott Physical Uranium Trust out of a almost 2-month trade range, and it's just attempting to break above all of its moving averages and to start to turn up. And again, a similar thing to what I said in gold, one day doesn't make a new trend, and I don't want to already say that this is for certain underway, but wouldn't it be interesting to see if the bull market resumed here in uranium as well?
Well, Patrick, I certainly think that the world needs a nuclear renaissance. Specifically, we should get rid of the old technology, boiling water Westinghouse reactors, and build these things in factories so that they are to much higher quality standards with much higher fault tolerance, and really, really invest in electrifying the global economy using a combination of nuclear and geothermal power. But, nobody listens to me, and I can't help but think, wait a minute, the trend, regardless of whether I agree with it, is really toward decommissioning nuclear power plants. And I think that Germany made a horrific mistake decommissioning 3 of their nuclear power plants so they can restart coal-fired electrical generation plants, supposedly in the name of the environment. I think it's very, very misguided policy. But it does seem to be the policy trend. So I guess I don't see how you get a real structural bull market in uranium until there is a change of policy. Now, maybe the market is starting to sniff out the need for that policy change and is expecting it to come soon. I sure hope so, but boy, I don't see in the political headlines any signs of it.
So moving on to page 9, I have that chart of wheat futures on the continuous, and I know Adam was referencing, and we should get his partner on to talk a little bit more about the ag markets. But obviously, we had a huge pop back in March in the upside of wheat futures. And it's pretty interesting to see that we've given almost all of it back. I mean, it's wheat prices, from peak down to trough have just obviously rounding, but have lost almost half of their value, and it's going to be really interesting to see whether this is actually where a key support line starts to establish itself, and whether, like many of the other commodities that have started to turn up, whether wheat is sold enough, and whether or not we're going to have some sort of a quick little bull reaction, at minimum, to retest its moving averages, which would be a return back to the 920 level above. It'll be interesting to see whether that starts to materialize here.
I agree, Patrick, and this trend in grains has been going on for years. It's really not just a result of the Russia conflict, but obviously you can see February 24th began a panic buy cycle. A lot of wheat exports come from Russia and Ukraine, and with the conflict going on there, everybody panicked. We got that blow off top. We've come back down to the pre-February 24th level. I think that might be the logical point for the resumption of a bull move from here. But then again, on the technical side of this chart, boy, it sure looks like we've got a death cross coming up on your moving averages here, or about to happen. It hasn't quite happened yet. So it'll be really interesting to see which way this market goes from here.
Eric, I just wanted to wrap up our little chat on the charts with just putting up the 10-year yield that we just discussed in the market wrap. And I really just wanted to make the quick observation of just how significant this little breakdown has been in yields, which is, the last time we saw yields like this was all the way back in April. I mean, we've seen a sustained push. We've seen extraordinary CPI print, and yet yields have really started to decisively roll over and potentially begin some sort of I don't want to say a new downtrend, but at least a deep mean reversion of the prior rise. And the question here is the bond market sniffing out the economic slowdown, and that we're moving down that direction. It's going to be really interesting to see how far these yields pull back during the cycle.
And the other aspect of this, Patrick, is that interpreting a chart like this becomes a little more challenging because with a recession imminent, you have to ask yourself, okay, is this chart telling us that the market is sniffing out that inflation's not really a big threat, it's peaked, it's over with, that's what the signal is? Or is it that inflation still is a problem, but the market is still smelling out economic weakness coming, and going into a recession, you typically get declining yields? Or is it some combination of those two things? It's really hard when you have multiple signals overlaid in the same price series to figure out what the driver is. And of course, that leads to lots of difference of opinion. But listeners, if you enjoy these charts and chart decks that Patrick puts together, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. You can find the information on slides 11 and 12 of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.